Hi, this is Shane with the Rational Trader. It is November 7th, a Wednesday, and NASDAQ was too wild again, so didn't trade that. I let ES go in Sim for -3, and we're getting close to trading oil here live. Still Sim this week, but I've got the replay program running. I've got the parameters locked in. Today I was trading with a 30-tick stop, which is a little bigger than I'm supposed to here, according to my work here. So this really needs to be 20. Let's just change it now while we're thinking about it. And then let's look at the trades that we took today. The net result is 0. Is that 0 or did it flip to 0 because we're in a new day? Let's see here. Trade activity log, period trade, daily. Yeah, 0. Okay. So let's take a look at it here. It's Wednesday, so there's a blackout around that news event. So nothing here in the morning, and then we start taking a look. 725 is right here, so we block out right there. Actually, we should be blocking out right there. Let's check and make sure. Yeah, so 605 to 725, and then 735 to 1120. Okay, so this is when the oil news comes out. Market goes kind of crazy this time, more like you expect. Not like the old days, but it's still pretty active. And right here is where we're going to start trading again. Nothing there. So there's a lot of codes on screen, all right, but we're only trading a handful of them. So for members, it's just these. What is that? These 10 codes. Okay, so what we've done is we've written a program that simulates the trading. It basically does what Sierra Chart does, but in a Python program, and so it happens in seconds instead of in hours and days. And then we use that to iterate through each code and with the different sets of parameters, and there's a grid search done, and what came out of that was this set of parameters, which is a a 10-tick stop, move the stop to -3 at +10, and then to +1 at +15, and then start trail by 20. Actually, a trail by 30 actually makes more, but over the full 100-day sample period. But you find I find it I'd almost rather make less than see those days where you get like you'll see today, we get several pretty nice trades and then end up scratching out on the day because the 30-day trail just gives back too much. I would have a different opinion if I was trading multiple contracts. I would take one off at 20 and then let the other go. The NASDAQ shows the same thing, by the way, just in testing. We can't trade it because it's too wild right now, but it shows something similar where if you trade 2 contracts, take one off at 20, and then let the other one go at 30, you do better with the bigger trail. Let's see here. So nothing here. Unfortunately, we missed this really nice move, this down move right here. No signal there. There's a lot of opportunities there too, but what you'll notice is that every one of these codes here, except for that one, that 251 is pretty sweet, right? That's picking the top. But all of these codes are showing long. All right, 127, 186, 193. So what we're learning from the grid search is that different behaviors are more predictable than others in different markets. And so what you see here is that, to the machine, the pattern of order flow looks long, all right? But we've also learned that it's not reliable. That pattern is not as reliable. That particular behavior is not as predictable in the oil market. So that's why we don't take those trades long. So we missed the down move, which is unfortunate, but we don't take multiple losses. That's the way to think about that. Let's see here. Later on, we take some trades though. Let's see. Okay, so here's this purple line is 9 o'clock. So there's a long. You get enough to. These are 7-tick range bars, by the way. You get enough to get to move the stop to entry -3, and then you get stopped out there for 3-tick loss. Get along here. Now this is interesting. That's a nice little run, actually, right? So 61, 66. That peaks out at 62. So that's, what is that? 30-something ticks. So it's really not that much. But on the break, we do an add. All right. And then so with the trail, we end up giving back most of that because we don't get any follow through on that break. So we only make 2 ticks there. Let's see here. And then we find a short here. And then, again, because today I'm using a 30-tick trail, we end up giving all of that back. Not a bad looking entry. And I think that's it. Yeah, that's it. So if you look at these entries, this is, I have to say I like this. That's pretty nice. That's pretty nice. There's no follow through today, so that's unfortunate. That long is not bad. That, if you're looking at it as a human, you'd feel pretty comfortable taking that long. All right, so I'm pretty happy with that. The what does the data show here? I don't have it on this computer, so I'll have to wait for one of our update webinars to talk about that. So across the last 100 days, so the sample goes from no, it was 5/17, so 5/18 through 11/2 worked out to be 100 days. Using a 20-tick stop, a 20-tick trail, 10-tick stop. The number of trades is average trades per day was 1.6. Okay. Total ticks was 703. So that's a nice gain actually across 3 months. Modeled on a $5,000 account. In fact, it's spectacular, just in percentage terms. So if we can see that moving forward, I'd be pretty happy with that, and getting pretty close here to trading oil live. So what's happened here is these markets are so wild, the indexes, I've just sort of given up until I see them calm back down. Every day I look now, and every day it's too wild to trade, and it's going to stay like that. Until this settles back down. It's got to get at least back down to that red line. Even that's pretty volatile, historically speaking. Okay, but what I've done is I've done the same sort of grid search with the NASDAQ through this period of time here, the yellow rectangle, with a model built using data up to that point. And what you see is that assuming you can get filled, which is not necessarily a valid assumption given how wild the market is, you can turn a profit. The machine can turn a profit. At least that's what the simulation shows. But because it's so wild, you take a lot more days where you're hitting max loss. So by contrast, in oil across that 100-day sample, we took 5 max loss days. So there's 5 days where you lost $200. In the NASDAQ, there were 25. So it's 25% of the time you're taking a full loss on the day. Not necessarily bad, actually, but it kind of sort of depends on your tolerance for loss. And my problem is with the indexes is that the more volatile they get, the more randomness there is in the market. And so I'm concerned that even at the yellow and red line levels of volatility, there's still enough volatility that the answer we're getting is essentially random. And if that's the case, then that just means that there isn't predictability there that you can use moving forward. And the easy answer there is just to wait and see. So I'll build the models every week, and we can just run them in sim until we start seeing the results turn in our favor. As it stands right now, it's too volatile to trade. So that's why we've changed our focus to a less volatile market. We started building in the room today. We started building the euro, taking a look at it, and then we were talking about other markets that are tradable or candidates to trade. All right, so we'll start with oil here, and then move on to the next market. Just kind of build up a library of markets to pick from, and then move from there. I can do that now because the Rev 70 architecture trains so much faster than the Rev 55. I couldn't do that with the Rev 55 architecture. It just takes too long to train. Okay, so that's it. We'll see how this oil finishes out this week, and then we'll start trading that live on Monday.